Welcome back to the cryptowrld channel, everyone. My name is Josh, and there is a lot of important information for me to cover in this video, ranging all the way from massive signals that are flashing right now for both Bitcoin and Ethereum. Also, we have new CPI data that has just come in, which updates the official inflation rate in the US. Also, there's other important factors affecting markets right now, such as the futures market pricing in a 1% rate hike at the end of this month. And not only that, we're also seeing a short squeeze play out right now. And there's some huge news for Celsius and the entire DeFi space in crypto, which I'll be covering later in this video. So sit back and relax, and definitely make sure you watch this entire video all the way to the end so you don't miss out on any of this important information. First of all, giving you an update on inflation because we just got new consumer price index data, which was worse than expected because the year-over-year inflation rate after this data came out was expected to be 8.8% year over year, but instead we got 9.1%. So obviously that is worse than expected. And in fact, that is actually very similar to what we saw roughly around 1 month ago, because if you're looking back at the last reading that we got, which was on the 10th of June for the May inflation data, according to consensus and the trading economics forecast, we were expecting an 8.3% inflation rate year over year, but instead we got 8.6% just last month. So that is obviously 0.3% higher than what we were expecting last month, and this time round we were expecting an 8.8% inflation rate, and instead we got a 9.1% inflation rate, which is also a 0.3% increase from what we were expecting. But the main difference between this CPI release and the last CPI release that we got a month ago is the fact that before we got the previous CPI data last month, so once again before we got that 8.6% inflation rate, we actually had 1 month here where we saw the CPI inflation actually trend down for 1 month. So when we were heading into the May inflation data, which once again was released on the 10th of June, leading up until that day right there was a lot of people in the market expecting inflation had already peaked back in March. Because obviously, as you can see here on this chart, that small decline that we saw in inflation during April was the first time in nearly 1 whole year where we actually saw CPI inflation come down for a month. So heading into the May inflation data, which was released last month, that led a lot of people to believe that potentially inflation peaked back in March, which would have been good news. But instead, when inflation came in worse than expected, not only did it come in worse than expected, it actually broke that previous high into a new higher high, which obviously confirmed the fact that inflation certainly did not peak back in March. Whereas this time round, obviously inflation is worse than expected by around 0.3%, and obviously inflation has broken that previous high into a new higher high. But this time, almost everyone in the market was already expecting inflation to actually become worse than last month. So essentially, there was just about no one pricing in a decline in inflation this month because obviously expectations were at 8.8%, which would mean that inflation would still be heading higher even if we hit expectations. And really the main reason why all of this inflation data heavily affects markets is mostly to do with what the Fed does. Because in case you don't already know, one of the Federal Reserve's main jobs at the moment is to try and bring down this inflation. And in order to bring down this inflation, they raise interest rates and execute quantitative tightening. And to explain those simply, rising interest rates makes debt more expensive, which puts downwards pressure on markets, especially if there's a lot of debt built up. And quantitative tightening is essentially the removal of US dollars from the economy. So it's basically removing liquidity out of the economy, which means there's less dollars flowing around out there actually buying stuff, which is hopefully going to reduce inflation. That is their goal. But as a direct side effect of removing dollars, removing buying power from the economy, and also increasing the cost of debt, that also crashes markets. And basically, if this inflation keeps getting further and further out of control, then the Fed looks to tighten their monetary policy tighter than what they were previously planning, and also raise interest rates higher than what they were previously planning in order to try and get this back under control. And once again, because quantitative tightening and rising interest rates crash markets, when inflation gets further and further out of control, that is actually seen as bearish for markets, because it means the Fed is going to have to do more tightening and raise raise interest rates higher than what they were previously planning. And we saw a perfect example of that playing out roughly around 1 month ago. Once again, we got that horrible inflation data a month ago, making a new higher high and getting rid of any ideas that inflation actually peaked back in March, which then caused the Fed to raise interest rates by 75 basis points, also known as 0.75%. But before we got that last inflation data last month, they were only planning to raise interest rates by 50 basis points, 0.5%. So due to that previous higher than expected inflation figure, the market then had to begin pricing in more bearish price action based on the much higher probability of the Fed raising interest rates by 75 basis points instead of just 50 basis points. Now, this time round, because we have year-over-year inflation in the US sitting at 9.1%, which is obviously well above expectations, a 50 basis point hike for the next Fed meeting later this month is basically off the cards. It's almost no chance of seeing just a 50 basis point hike. And so now everyone is expecting either another 75 basis point hike or a 100 basis point hike, which is a full 1% increase on top of the federal funds rate, which is currently sitting at 1.75%. So if we end up seeing another 75 basis point hike in the next Fed meeting, which is in around 2 weeks from now, then that would place the federal funds rate, which is essentially the Fed's interest rate, at 2.5%, which is that 2019 high. And if we end up seeing a 100 basis point hike at the next Fed meeting in 2 weeks from now, then that would place the federal funds rate at 2.75%. And if you zoom all the way out on this chart, going back to the 1970s, we are potentially about to see a break in this 40-year-long downtrend in interest rates, which could actually be extremely disastrous. And I won't go too much into detail about all of that in this video. I'll briefly explain it. But if you want me to make a separate in-depth video about all of this, definitely let me know in the comment section down below, because this is seriously important. But just briefly explaining why this could be extremely disastrous financially. Basically, as you could imagine, as interest rates go lower and lower, once again, that makes debt cheaper and cheaper. We end up seeing more and more debt actually build up in the financial system, in the economy. And in fact, right now in many different economies across many different countries all around the world, debt levels are pretty much at all-time highs. And almost all of that debt has been building up in this time period, in the last decade approximately, while interest rates have been near zero. So essentially, that debt that has built up during that amount of time, which is certainly not a small amount of debt, by the way, we're talking about tens of trillions, if not hundreds of trillions of dollars of debt, that simply cannot survive on higher interest rates. That debt can only actually survive on near zero interest rates. So if we see a break in this 40-year downtrend in interest rates with all of that record high debt, hundreds of trillions of dollars of debt that cannot possibly survive on higher interest rates, basically we would reach a massive breaking point somewhere in the economy, whether that's the fiat currency or the economy itself, or even entire banks and governments going bankrupt. And if you think that sounds crazy, this is actually already happening in developing countries with weaker economies. But anyway, getting back on track, like I was saying, the federal funds rate at the moment is sitting at 1.75%. Well, technically their target range is in between 1.5 and 1.75%, which is the same thing as 150 basis points to 175 basis points as the Fed's target rate for the federal funds rate. And now taking a look at the target rate probabilities for the 27th of July Fed meeting, which is the next Fed meeting later this month in around 2 weeks. And what this shows us is actually what the futures market is currently pricing in terms of the probabilities for the Fed's decision at the next Fed meeting on the 27th of July. And right now, at the time of recording this video, the futures market is currently pricing in a 75% probability, so a 75% chance of a 100 basis point hike and just a 25% chance of a 75 basis point hike in 2 weeks from now at the next Fed meeting. Because underneath this 25% probability column, we can see the Fed target rates between 225 basis points and 250 basis points, which from their current target rate between 150 and 175, that would be a 75 basis point hike, which once again is a 25% chance of happening. But then underneath this other probability column, we have the target rate for the federal funds rate at 250 to 275 basis points, which if you're measuring from right now, once again, 150 to 175, that would suggest a 1% rate increase. So a 100 basis point hike, which is currently already priced into the futures market at a 75% probability. And what is really interesting is you can actually take a look at all of the future probabilities based on what the futures market is currently pricing in. And as of right now, the majority of the futures market is once again pricing in a 100 basis point hike at the next Fed meeting in just 2 weeks from now. And then we don't have a Fed meeting in August. The next Fed meeting after the one in 2 weeks is actually on the 21st of September. And currently the futures market is pricing in a 75 basis point hike at that September Fed meeting after a 100 basis point hike this Fed meeting in 2 weeks. And then what we see is really interesting, because if you take a look at the November Fed meeting on the 2nd of November, the majority of the futures market right now is pricing in only a 25 basis point hike. And then if you take a look at the probabilities for the next 2 Fed meetings after that, which take place in December this year and February next year, currently the futures market is tossing up between another 25 basis point hike in December this year, or potentially for the federal funds rate, the Fed's interest rate, to remain the same from November all the way through to May next year. And then they're actually pricing in interest rate cuts. That is right, interest rate cuts around the middle of next year, specifically around June and July. The futures market is currently pricing in. They are putting money on the table for interest rates to begin declining towards the middle of next year. So this is definitely something very interesting that I'll continue to cover on this channel moving forward, because it can give us some good insight on how long the recession might last for, based on whether or not the Fed is tightening or easing their monetary policy. But anyway, now jumping into the charts, just giving you a quick update on what the US stock market did today. This right here is the Nasdaq 100 index on the daily time frame. And immediately when the US stock market opened, the Nasdaq opened well below yesterday's daily candle close, because at the exact moment that that bad inflation data came out, we saw an immediate drop off in the stock market and in crypto prices in the immediate short term, just in the minutes following that data. But then what was very interesting to see was enough liquidity to actually support a small sell-off here. So essentially, this time round, there was more buy orders to actually support the price action, so we didn't see an immediate crash like what we saw last time. But with that being said, honestly, considering the recent inflation data, I would have expected prices to actually go down a little bit lower in both the stock market and in crypto. But then again, that may end up happening between now and the next Fed meeting in roughly 2 weeks from now, as we wait for the rest of those market participants to actually price in that 100 basis point hike. And already, since when I was just talking about it a moment ago, this probability of a 100 basis point hike at the next Fed meeting has increased again, up to a 78% probability. So the fact that we've now removed the uncertainty of that inflation data, because obviously we now know what those numbers are, and the fact that the market supported with enough liquidity the pricing in of that potential 1% interest rate hike, that could be one of the reasons why we've seen a bit of a short-term bounce in both the stock market and in crypto prices. Because right now in the immediate short term compared to yesterday, we have reduced uncertainty, which means reduced risk. But at the same time, because the market is pricing in a potential 100 basis point hike in 2 weeks from now with high probability, that could also be one of the reasons why we've played out a bit of green price action throughout the trading day in the stock market, which has also transferred over to the crypto market in the form of short-term bullish price action. But either way, between now and the next Fed meeting, I'll still remain a little bit more on the cautious side, because we do still have some risk of potential downside price action. But anyway, getting into the Bitcoin part of this video, this right here is the weekly Bitcoin chart, and these indicators are the Pi cycle bottom indicator and the weekly Bitcoin RSI. And first of all, if you're looking at the weekly Bitcoin RSI, this is currently sitting in oversold territories for the 3rd time in Bitcoin's entire price history. The only 2 other times this has happened was at the end of the 2018 bear market and the end of the 2014 bear market. And interestingly enough, those were also the same times where we saw this Pi cycle bottom indicator flash an actual bottom signal, which signaled the bottom of both of those previous Bitcoin bear markets back in 2014 leading into early 2015 and back in 2018. And today we are officially seeing this signal flash for the 3rd time in Bitcoin's entire price history. Once again, the 2 other times this signal has flashed were both bottoms of previous Bitcoin bear markets. But I went into more detail about the Pi cycle bottom indicator in my last video on the channel, so if you missed my last video that I posted yesterday, definitely check that one out. Now, if you're zooming into the daily Bitcoin chart, taking a look at this choppy sideways price range, which Bitcoin is actually still holding between. This horizontal level of support that I've got here, which by the way, I haven't changed in weeks now, you can check my older videos. This support line is sitting in between around 18,500 up towards 19,000, showing an important level of support in the shorter term. And as for resistance, we have strong resistance close to $22,000 per Bitcoin. And as I've been saying in these videos over and over again for weeks now on the channel, as long as the daily Bitcoin RSI remains in this uptrend, so basically forming higher lows and higher highs, then it is extremely likely for the Bitcoin price to at least remain in this choppy sideways price action, or potentially play out some slightly bullish price action if we played out what we saw in the first quarter of this year. So essentially the situation at the moment on the daily Bitcoin chart, right now we're basically in a pause in this larger downtrend, similar to what we saw roughly 1 to 2 months ago and somewhat similar to what we saw in the first quarter of this year. It was simply a pause in a larger downtrend. And in case you don't know, there's actually some very simple strategies to make a lot of money during a choppy sideways price range. So while there's a lot of people out there that think choppy sideways price action is just boring price action, in reality, this is actually a price range where we can really rake in a lot of profits. And if you want to know exactly how to do that, stay until the end of this video. But anyway, while we're on the daily Bitcoin chart, taking a look at the Bollinger Bands indicator, and right now we're still in this squeeze formation. We haven't yet seen that extremely volatile move, but technically speaking, according to the history of this indicator, we should be getting pretty close to that volatile move, potentially in the coming days, because in most cases, from when we enter the squeeze formation in this Bollinger Bands indicator, we usually end up playing out the volatile move within around 1 to 2 weeks from when we enter the squeeze phase. And if you measure from when the Bollinger Bands began squeezing, that was roughly around 9 to 10 days ago, so about a week and a half ago. So this is just something else to keep in mind when looking at the overall situation. Now, zooming into the 12-hour Bitcoin chart, I spoke about yesterday how the Bitcoin price is potentially trading below this upper trending line of support, which was sitting at around 19.5 to 19.6k. And if you watched my last video, you would already know this, but basically what I said in my last video and also multiple other videos is that we still have a lot of support at around $19,000 per Bitcoin. So essentially, if we break that upper trending line of support, what I said yesterday is I expect quite a lot of support down towards 19,000, where we could see a potential bounce. And at the time of recording this video, the Bitcoin price has bounced from just underneath $19,000 per Bitcoin. And since yesterday, we've seen one 12-hour candle close on the Bitcoin chart back above this upper trending line of support. And if we see another 12-hour candle close above this line of support, which is currently sitting at around 19.6k, then on this next 12-hour candle close, we'll also have a daily candle close. And a daily candle close back above this line of support would essentially invalidate any sort of potential breakout to the downside that we saw just the other day. So basically, this break to the downside is potentially a fake out if we confirm another 12-hour candle close, so a daily candle close back above this upward trending line of support. And now zooming into the shorter term, taking a look at the 4-hour Bitcoin chart, specifically the price oscillators, the RSI and the MACD, we are finally starting to see these short-term price oscillators on the 4-hour Bitcoin chart begin flipping bullish. Now, obviously, I mentioned yesterday that the 4-hour Bitcoin RSI was in oversold territories, and the last time that happened, that put in a short-term bottom for Bitcoin. And so far, this is holding up to potentially be true again. But what I also mentioned is ideally for extra confirmation, we need to see some higher lows and higher highs start forming in the 4-hour Bitcoin RSI, and also a bullish cross in the 4-hour Bitcoin MACD. And right now, as of recording this video, we're potentially just about to see a bullish cross in the 4-hour Bitcoin MACD, but we would also need to see at least a 4-hour candle close after seeing the bullish cross in this indicator to actually cement it in place. But what we are already now starting to see on this 4-hour chart is the 4-hour Bitcoin RSI begin some higher lows and higher highs. So if we just get a little bit more confirmation with this bullish cross in the 4-hour Bitcoin MACD, then when it comes to the short-term price trends for Bitcoin, we could potentially be getting ready for a short-term movement back towards this level of resistance. But obviously, when I'm talking about these bullish and bearish trends on the 4-hour chart, this is only talking about the shorter term, as in the price action and the price trends that play out over a few days, maybe up to a week or two max. But when it comes to the larger trend, obviously we are still more bearish than bullish at the moment on this weekly Bitcoin chart or the daily Bitcoin chart, for example. But obviously in the shorter term relative to the daily Bitcoin chart, we're simply in a choppy sideways price action similar to what we saw roughly 1 to 2 months ago. And after saying that, I'm probably going to get a couple comments on this video telling me that I'm only saying that Bitcoin is about to play out either bullish, bearish, or sideways price action. And for those people, I strongly recommend you doing a little bit more research in how timeframes work, because believe it or not, but the short-term trend on the 4-hour chart, for example, could be starting to look more bullish, while the larger trend remains bearish. That is still possible and doesn't contradict each other. But anyway, now getting into the Ethereum part of this video, this right here is the daily Ethereum chart, taking a look at the Bollinger Band indicator, which is right now in this squeeze formation. And in case you're new to the channel, the same rules apply here as what I said on the daily Bitcoin chart around the Bollinger Band indicator, which basically means we're still due to see an extremely volatile move coming sometime soon. And in order to determine what direction that volatile move could take, I'll be looking towards our levels of support and resistance, which for Ethereum, we have resistance sitting at around 1270 to 1280, and we have horizontal support at around $1,000. And in fact, we can look at those levels of support and resistance a little closer on the 12-hour Ethereum chart. Once again, we have that horizontal level of resistance at around 1270 to 1280. And by the way, you can go back and check my videos. I was talking about this strong level of resistance before we even got this rejection. But then what we've seen over the past couple of days is actually a confirmed break to the downside from this ascending line of support, which was coming into play at around 1120 to 1130. And as soon as we got confirmation of this break to the downside with that 12-hour candle close, which at that time was also a daily candle close, since that moment, I've been targeting around $1,000 as our next most important level of support. Once again, you can check my other videos if you don't believe me. And so far, as of recording this video, the price of Ethereum came within just a few dollars of $1,000 before we saw this short-term bounce. And if you're zooming into the 4-hour Ethereum chart, we can also see similar indications on this chart to the 4-hour Bitcoin chart when it comes to the RSI and the MACD. Basically, the RSI is starting to form higher lows and higher highs after coming from oversold territories, very similar to what we saw around 2 weeks ago. And also, if you're looking at the 4-hour Ethereum MACD, at the time of recording this video, this is currently crossing over into the bullish direction. But once again, we still actually need to see at least a 4-hour candle close to cement that bullish cross in place. And another reason why we could be seeing a bit of a short-term bounce at the moment is because we're seeing a bit of a short squeeze happening. This right here is the Ethereum short positions over on the Bitfinex exchange on the 1-hour time frame. So each one of these candles is obviously 1 hour. And as soon as that inflation data came out, we saw a lot of short positions open back up, especially for Ethereum on the Bitfinex exchange. And then not long after, within just a couple hours after, we started to see those late short positions quickly get squeezed out of the market, essentially getting punished for being late to the trade. And as of right now, there's still a lot of these shorts that are remaining open that are potentially in a loss that could still get liquidated, which could help provide a little bit of bullish pressure in the immediate short term. And on top of that, something else that happened all around this sort of time was the fact that Celsius actually paid off pretty much all of their on-chain debt. So in case you don't already know, Celsius just 1 month ago had on-chain debt worth around $820 million US, which meant Celsius owed around $820 million US worth of various stablecoins to various DeFi platforms such as Maker, Aave, and Compound. But as of recording this video, they've gotten down that $820 million worth of debt all the way down to just around 70 grand. And that $70,000 is just a small amount of REN that they owe on their Aave position. So due to this is going to help stop the spread of financial contagion in the lending space, the crypto lending space, specifically in DeFi. And I won't go too much into detail about all of that in this video because that will take a while. And if you want me to make a whole separate video going into much more detail about all of that and what's happening in DeFi, let me know in the comment section down below. But just to quickly explain what has happened in DeFi in recent months, basically due to crypto prices like Bitcoin and Ethereum going down, that has caused the value of collateral under multiple DeFi platforms to go down, which means there's less money backing up the loans. And essentially, once it goes below a certain threshold, those loans begin getting liquidated, which essentially means that collateral begins getting sold onto the market, which puts down crypto prices even further, which liquidates more loans, which puts down prices even further. And basically, that whole liquidation cascade is essentially what's been happening in crypto in recent months. But because of the fact that Celsius has pretty much removed all of their on-chain debt, this has now taken away the risk of Celsius potentially getting liquidated on one of those on-chain debt positions. So this is actually really good news for DeFi and in crypto overall, but not necessarily for Celsius. And if you want to know exactly why that's the case, check out this thread that I posted on my Twitter. And the link to my Twitter is in the description down below and also in the pinned comment. And if you want to maximize your profits in crypto, whether or not the price is going up, down, or chopping around sideways, check out one of these videos popping up right here on your screen. The video in the top left shows you how to make money in crypto if the price is going up or down. And the video in the bottom left shows you how to make money if the price is chopping around sideways. But anyway, that's everything that I have to say for today. I really hope you enjoyed, and I'll see you all in the next video.